leadership while also serving as director of the Livable Communities Council. Please join me in welcoming Sarah this morning.
Thank you.
Thank you.
Good morning. How is everyone? Excellent. So bear with me for a minute while we swap out technology. It is nice to be back with you all. I think I joined you all about 2 years ago, maybe 3 years ago, for a similar conversation when we were earlier in this expansion cycle. All right. Oh, it's touchscreen, right? Well, again, I'm Sarah Kirsch. I'm Executive Director of ULI Atlanta. I see a couple of ULI members in the audience, but for those of you who are not familiar, the Urban Land Institute is a global nonprofit. We are a member-driven and mission-driven organization. So I like to say that no matter what you do in the world of real estate and city building, you should be a member of your core organization, like CCIM, or if you're an architect, AIA, or if you're a landscape architect, you should join that organization. But everyone should be a member of ULI because it is the one place where everyone who touches where cities get built comes together to focus on how we build better places. So we've got about 1,000 members here in Atlanta proper, about 1,200 in our district, which includes all of Georgia, Alabama, and Eastern Tennessee. And we do programming and technical assistance and all sorts of work to advance that mission of responsible land use. So one of the core practice areas of ULI is advancing the practice of real estate development. And you don't often hear people talk about the practice of real estate development. We practice law, we practice medicine, but as we all know, real estate development is a practice, and you hope to get better with each deal, and you hope to learn from the broader macro trends that impact how we build, where we build, redevelop, and so forth. And so this is one of the ways that we do this. This is our annual Emerging Trends in Real Estate. It is the 39th edition, which I would not have guessed we've been doing it that long. And it's a partnership between PwC and ULI. We conduct the research at a couple of levels. Over the last few years, we started doing focus groups in all of our major core markets, about 16 core markets. We do about 500 one-on-one interviews. And then we complete about 1,600 online surveys. So if any of you took it, thank you. I'm told it's a grueling survey. It's not, the 10 questions that you click through, but is a very robust survey. So the headline for this year's Emerging Trends is Navigating at Altitude. And we like to joke it's not that we were out of sports analogies or out of nautical analogies, so we've moved to aviation, but that's truly representative of what people told us, is that we are long in the cycle and people are trying to find opportunities. Specifically, it's not a boom bust. The key to the next few years is to expand horizons, market by market, property type by property type. Talked about that. So how this was done in the latter part of 17, and looking at, at the highest level, how were people feeling about 2018 at that point, which is helpful not just in terms of thinking about 2018, but thinking about it historically. So how would you characterize the expected profitability of your real estate business in 2018? A, was good or excellent, B, fair, C, abysmal, poor. So fairly similar to 2017. Only 1.1% saying abysmal. So there's always that guy in this case, those 17 guys who are just having a really bad year. Fair, a slight uptick, and then a slight downtick in good, excellent. Interesting to sort of tease out the good versus excellent. Good has moved to a record high in this cycle, but excellent has moved down from what has been the high of this cycle for the 8+ years. So just sort of interesting, taking the temperature of how people are feeling. And I should have said this at the beginning. Feel free to interject, raise your hand, call out questions. Obviously, the kind of market sentiment is changing on a daily basis. And so today I hope to focus on some of the more macro trends that we think are influencing longer term. So to that end, we have these core emerging trends in 2018. Some of these we think we will see in a meaningful way in 2018. some of these are things that you should start keeping your eye on as you're planning for 19, 20, 21. Long glide to a soft landing, knock on wood. Working smarter and harder, which is a little different than maybe what you think it is. Procession of generations. We are hearing for the first time people talking about Gen Z. This is the generation that comes after the millennials. We will talk about that in a minute. But don't forget the boomers. Retail transforms and stores remain, meaning the physical stores. Housing at a technological tipping point, and it's different this time, isn't it? So a long glide path to a soft landing. I want to hit on a couple of these. I heard Wayne said earlier, we were chatting, people always use the sports analogy of what inning we're in. Someone said in this year's, I hate the what inning we are in question. It makes it seem like cycles have to end after a preset time has elapsed. Maybe it's going to be a double header. So, yes. I think this is really interesting. This is a graph that looks at all the past cycles. You have GDP growth on the bottom, employment growth on the vertical axis, and then the size of the bubble is how long it has lasted. And so here we are, and at this, I've been told to carry this. Hold on a second, or y'all may not be able to hear me. So here we are at 103 months, which is a long cycle, but pretty consistent with the trend that you're seeing, right? Where the slower growth and the longest term. But you do look up here. We got 121 months in the 91 to 01 cycle being stronger growth, but does point to this trend of being the slower, more constrained growth, suggesting that this longer soft glide, or long glide rather, to a soft landing may be more sustainable. So I think that's just an interesting factor. You look at interviews also point to a healthy lack of late cycle enthusiasm that we saw in 2007, and maybe it's serving as a hedge against the risk. We saw this a few slides back with the good line going up and the excellent slide going down. At the same time, we hear about lower leverage. As one interviewee said, people don't lose money on the real estate, they lose it on leverage, which is something we learned the last hard landing. And this slide reflects what we hear about pricing, except for some exceptions in luxury multifamily and in central business district office and in a handful of coastal and primary cities. Prices have not heated up, which we believe is minimizing the risk of a major price correction. So perhaps a bigger part of the story is the pricing gap between the major markets and the secondary and tertiary markets. This being all property types in non-major markets versus the major markets, where if any of you have followed emerging trends, maybe last year or the year before, you noticed all of the gateway cities really falling out of the top list. And you heard things like, with the influx of foreign capital, we just can't make deals work in the New Yorks, the Chicagos, the San Franciscos. They're accepting much lower rates of returns, and we just can't compete. So that's when we started seeing an uptick a few years ago in places like Atlanta and Charlotte and some of the Florida markets. So now we're seeing, an even increased shift as people are looking to, again, navigating at altitude. What are other markets that may not have been on our radar 3-4 years ago that people are looking for opportunities? So working smarter and harder. This sounds terrible, right? Who wants that? The promise was that we would, have technology and we could work smarter and less. And I don't think anyone believes that that's the case. However, this is not intended to be about people. Real estate facilities are not just overhead, but a way to improve not just employee happiness and engagement, but also productivity. So this is not about making your employees work harder. It is about how to make your real estate assets work smarter and harder for you and your employees and tenants. So facilities are not just about employee recruitment and retention, they're about productivity too. So we see this in a number of factors. I think this is interesting. Productivity growth continues at a much lower rate. This is surprising to me. I would not have guessed this. This is the average annual wage, productivity per person, and seeing that real growth in 91 to 10, but seeing that much more moderate growth in this cycle. So there's a connection between this and real estate, because in the end, it's the revenue production that pays the rent. Like we see, you can think about this most in retail, right? Thinking about retail rents as a percentage of sales. Well, in office, the productivity per person being what's driving the rents, essentially, right? So an interesting thing of people shifting their focus on how you get more productivity out of people and therefore out of your real estate assets. This isn't showing up on this slide. Well, we'll move to the next one then. We have plenty of content. Oh, there we go. So change in worker output versus employment growth by sector. So this is showing the changes in productivity by sector. The largest increase in output per worker is no surprise, is technology, but with less employees. Real estate and rental and leasing is the only other sector with high productivity increase than employment. So productivity increase is likely due to greater utilization of new tools, such as online platforms, and finance and real estate and insurance is one of the lowest increases in productivity, which points to that office connection we were talking about. So an interesting way to think about how underlying economic conditions, productivity per employee, then relates back to the value of real estate assets, which isn't something that I'd ever thought of as a way of thinking about it. This is ULI's CEO, Patrick Phillips, if you're interested. It's all about return on investment, and it's human capital that counts the most, where investment really pays off. Get smart about the workspace. Today, it's all about the smart experience as well as the smart building. So this was a real redesign of ULI's headquarters in Washington to a much more efficient but collaborative workspace. So, working smarter and harder. Given the age of our office stock, will we be able to meet these changing needs of a different type of work environment, of getting more out of your real estate assets and getting it to work for you? Only 19% of stock has been built this century, which is, it's 2018, you sort of forget century-wise. So to the right of the dotted line. And so there's this question about what will have to happen to make sure there is enough quality space as we think about repositioning some of the older assets. And this is not an impact only on supporting productivity, but also on challenges ranging from capacity for shared workspaces to potential redevelopment of suburban office parks. And that's one you started hearing a lot more about. We're seeing in a more meaningful way of how we think about reimagining the suburban office parks that have not been the darling of the real estate investment community for quite some time. For the sake of time, I'm going to move through some of these. So, procession of generations, Gen Z. So, we spent, I have 3 members of Gen Z in my family. Those are my 3 boys. And they were talking to me the other day, saying, Mom, what's all this generation stuff about? What does it even mean? Who really cares? And I was explaining to them that there's this belief that many of you are probably familiar with, that sort of what happens in your formative years, say 16 to 22, really defines what's going on in the world, really defines your outlook. And even what happens sort of from birth on related to technology is one of those key things that we think about. So we talked about boomers forever. The first part of my career, it was all about the boomers, right? It was the move-up housing. It was the luxury housing. It was the second home market, sort of leading into the last downturn that was really heating up with boomers thinking about vacation homes that would be ultimate retirement. And then out of the downturn, it was all about millennials, right? Biggest generation in history. There are more of them than their boomer parents. And now millennials are sort of well into, they're past the peak of their renter age. They're moving into first-time home buyers, having families, so forth. And so who's this generation behind them? Right now we're calling them Gen Z. I'm sure we'll call them something else. Some folks call them the digital natives. Some call them the homeland generation, given that they're the first generation. This is a little depressing. They're the first generation that doesn't remember a pre-9/11 world. So that's an interesting way to think about them, right? So procession of the generations, Generation Z. We've 7.8 million boomers, a little over 7.8 members of Gen X now, which is, Gen X is now a little bit bigger. It's my generation. Millennials now being the biggest at 7.96, and then Gen Z at about 65 million. So that's just some numbers for your reference. One of the quotes that came out of Emerging Trends this year is, "It isn't what you know that you should be worried about, it's what you think you know." So we all said that boomers were going to retire early and move to mild climates. Not so fast. Then came the Great Recession, and one of the emerging trends that we often talk about is the sort of third career of boomers, right, as they're thinking about retirement, but retirement might involve a different job, being a professor and so forth. Gen X, we're going to want bigger suburban homes. That didn't happen either. Millennials, we're going to be urban forever, but the majority of millennials are living in the suburbs already. So, caveat all of this with, okay, we think we know what these are, but they tend to work out a little different. Gen Z are just now entering the market from a real estate perspective. They were born starting in 1995, so the oldest are just out of college, and they are those very young people in your office. Couple of things we've gleaned about Gen Z so far. They seem to have the same initial preferences for urban centers as millennials. Where the first jobs will likely be is probably going to be in these urban centers. Peer-to-peer interactions is easiest in kind of more dense urban centers. But at the same time, surveys of housing preferences by brokerage firms indicate a much higher desire for home ownership. But of course, you would expect that the house would have to be smart with every possible home intelligent design. And one observation was that this is a group that grew up with the do-it-yourself HGTV. They've been watching House Flippers and all of that their whole lives. So this idea that there's a stock of housing out there that they can go and buy cheap and invest and turn around, or even better for their own use, is sort of in the Gen Z psychology, which is interesting. This is also interesting. Some tidbits from the Society for Human Resource Management. They seem to be seeking salary and benefits more than making a difference. So we've been hearing about millennials that they care more about making a difference and how their career is going to be tied to their social goals and their making a difference in the world. Gen Z so far seems to be more concerned about the money and the benefits. And so, this is a generation that experienced the Great Recession in a really meaningful way. They saw their parents lose their homes and their jobs. They are looking for security. Some are already saying they would stay 10 or more years in one job. Totally different than, and maybe they're just saying this hoping they're going to get hired, right? Yeah, I'll stay for 10 years. And that's certainly different from the millennials, where the hallmark has been the gig economy and moving around to move up. Gen Z seeks mentoring and hands-on management so that work-at-home arrangements may be less attractive. And this is another little soundbite out of Emerging Trends. 35% of Gen Z would rather share their socks than their office space. They are not interested in collaborative work environments. So we've learned from some of our members who are really involved in designing college spaces. So colleges over the last 10 years have totally redesigned their common areas to be these collaborative workspaces and do away with the private spaces. We now all see it in our office. And now you can walk around college campuses, apparently. I don't have any kids looking yet. And all of those spaces are either empty, or there are kids sitting there on their devices with their earbuds in, and we may be working together, but we're doing it digitally, and we're not talking to each other, right? So we're working in a Google Drive doc together, and we may be sitting in the same room, but it's this online collaboration that this generation is growing up with. and less interested in the physical collaboration. So that's just an interesting. So all of that said, it's just to percolate, how could this new generation impact some, particularly office. We've been talking for years about the war for talent really driving how we're thinking about office space. We've seen it locally with NCR, all sorts of other folks highlighting their desire to be near Georgia Tech. So if the war for talent is still going to drive so many office location decisions, what is this next generation who's oldest or 23 going to tell us about where demand will be? But don't forget about the boomers. If any generation has demonstrated an extended capacity to surprise, it's the baby boomers, who are our second demographic trend. I referenced this before. Boomers plan to stay in the workforce longer. We thought the boomers would retire by 60 or 65. The oldest is now probably turning 72. For a number of reasons, boomers appear to be planning to work longer. In just the last 7 years, boomers' planned retirement age has been pushed back. Working boomers aim to retire between 65 and 69, grew from 26% to 32%. And working boomers aiming to retire at 70 or older grew from 17% to 27%. So having 1 in 3 roughly boomers still working past age 70 is an interesting way of thinking about the workplace. This says that if you have a boomer working for you now or with you, at least half will be around for a while. This is labor force participation rate over time of 65 to 74. And if someone may be able to correct me on this, my understanding is we don't actually track labor force participation above 74. And so there's this whole missing element of how much folks in their older ages are working. But just the 65 to 74, you can see marching from 17% expected to be forward to 2024 of almost 30%. Just an interesting. So housing, next big emerging trend, housing at a technological tipping point. What do I mean by this? Here's a quote from Emerging Trends. I've been hearing talk about how technology will transform the way builders build homes for 25 years. We've been saying it's going to happen. Now I look at what's been happening, and for the first time ever, I'm thinking it's more than just talk. So this is modular, any home builders in the room? I didn't think so, no. If you'll talk to a home builder, they'll say, we've been building the same way we build for, 100 years, right? If we're talking about stick built. There's been no real innovation. We all see the cost going up a lot. We've been talking about, I remember 10 years ago saying that we were on the precipice of really adopting modular construction. The term then that people used was systems built, because no one wanted to live in manufactured housing. But if it was systems built housing, that sounded appealing. It'd be built off site and then moved on. And it never, with the Great Recession and so forth, who knows if that was the factor, but never really took hold. But you have folks in the home building world saying, for the first time ever, I'm thinking this is more than just talk. So why might this be so? Higher sales prices won't guarantee more new homes. Atlanta is called out as an exception to this trend. But if any of you follow permitting trends, Atlanta, for about 25 years running, we built about 60,000 homes a year, multifamily and single family, taking out those crazy 95,000 a year trends. And we are one of the biggest growth markets in terms of increase of production since the trough. So we're getting about 40% up from the trough of production. That said, we're still building half as much as we were in the 25 years before the Great Recession. We're still only building about 30,000 homes a year. So for anyone who took economics, right, you build less of something, you constrain supply, prices are going to go up. That's the general consensus. And in Atlanta, we are seeing, as anyone's read any headline or followed the mayor's election, housing affordability has become an issue in Atlanta for the very first time. That said, we are one of the few that is showing the change in the housing price index has also driven increase in production. So even here, where we're still only half of what we used to build, and it's driving affordability challenges. We're still only up 40% from trough. Most of the nation is below that. So you're seeing all of these price increases, but we're just not building the housing that you would expect to find when you have those prices, right? So, yeah, sir. In Atlanta. So let me see if I can remember my numbers correctly. So multifamily is in that 30,000 versus 60,000 number. Multifamily, we're back to about 90% of peak, so which you would say is fully recovered, right? Let's never get back to those peak production years of 06, 07. So multifamily from a production perspective is about fully recovered, but it's all concentrated in urban cores generally and the highest price markets. You're not seeing, at least until about the last year, a whole lot of suburban multifamily, which would be kind of the mid-market production, right? So we're building about as much as we used to. It's the single family that is just, I think it's 40% of peak, which would be more consistent with this number. So Atlanta's affordability, if you go on Moody's and you look at, strengths of a market versus challenges of a market, Atlanta, affordable cost of doing business and affordable housing has always been one of our top three. Generally, that housing affordability was on the backs of kind of drive till you qualify, right? You just keep building out and out and out. And, I remember, when I started in this business, you could get a starter single family home for $110,000. A single family home, right? You can't build it for that today, right? By any stretch of the imagination. So we're having in Atlanta, some real pressures on pricing because of that as well. That's probably another talk. So back to the technology piece. So higher sales prices won't guarantee new homes. You would expect in somewhere like a Miami, a Seattle, a Salt Lake, that this really tremendous change in the housing price index would create opportunities for more production, and it hasn't. So people are starting to look at it and saying, how do we solve this problem differently? What are different ways we can build? How can we get more production? How can we build more affordably? So that's going to be we're seeing some of the first modular multifamily coming online at the King Memorial TOD in the city. And I think the first modular single family in the city coming online. So it'll be interesting to watch. Yes. Yep. Yeah. We have more demand than supply, even though by national standards we're doing well. So, if you're Amazon looking for a market that can accommodate a major infusion of new jobs, you look at Atlanta and you go, oh, they're doing well with the level of housing inventory keeping up with supply relative to demand, but relative to historic norms, that's not the case. So, we've seen. And compounded with that is a lot of inventory coming offline. So yeah, we are any realtors in the room? So how many months of supply do we have? 4? 3? Atlanta used to run at 9 months of supply. That was sort of steady state. We'd say that was healthy. And I think for years running, we've been down to 3 to 4 months of supply. So yes, and that's why we're in the notes in mailboxes phase, right? You get the letter in your mailbox that says if you're interested in selling, right? Yeah. It's a good question. So I do think there's some level of lenders being constrained. I think a lot of it is kind of NIMBYism, right? We have very more markets you are seeing in an anti-growth position, both locally and certainly nationally. So the not in my backyard phenomenon that particularly if it's related to density, but even the woes over traffic, concerns over schools, those are always the two critical issues, and it's just getting harder to get the approvals. So that on a national scale, I mean, we have a publication that's called Yes in My Backyard, which is sort of why you should embrace production of housing in your community. But nationally, that's certainly a factor. In Atlanta, I mean, it'd be an interesting conversation to have. Atlanta used to be a market of smaller home builders. Yeah. Yeah. So salaries. Yeah. So salaries. I wish I had the slide with me. Salaries are generally flat. On a cost-adjusted basis, they're negative. We've seen about 1% salary compounded annual growth rate in the city of Atlanta. That's 1% a year, whereas housing prices are going up 5 to 10% a year across the board. You know, region-wide, I think income growth is 0.1%. And y'all been following what's been going on with housing costs. So yeah, there's some fundamental issues that are driving it. So you know, this is from how does the market respond? Which I think is, part of your question. One of the emerging trends here is that we think the market will respond by finding different ways to build. So, we all have our, yeah.
Just an observation, the no-growth communities become far more effective in their ability to use social media than the builders, developers who are trying to create new projects. The builder developers are behind the eight ball, figuring out how to be more effective because the no-growth is crushing.
Yep, that's a great point. So we do work across the region, and you hear about the value of authentic community engagement, primarily in redeveloping areas, because there is so much anxiety about displacement, right? So, which is both real and perceived. There is real displacement from property taxes and so forth. There's perceived displacement because if you're in a neighborhood where there's been lots of vacant housing, and all of a sudden you see people moving in, you feel like you're getting displaced, right? But it's just sort of repopulation. So we talk about that a lot in revitalization situations of how the private sector really needs to get their arms around what community engagement looks like to engage people early and often. But I think it's becoming increasingly important no matter where you are, right? Is let people have some say in, let the community make your project better, right? You're building for those folks, right? And so it's generally an education gap and a fear factor of what is this going to be, and so this is more interesting conversation than emerging trends, right? Not much relief in sight for home construction costs. This is the index of new price index relative to 100. We're up 124. Housing inventory continues to drop amid tight credit and a growing tendency to become, I think that's going to say anti-growth. Record low housing inventory is freaking us out, says one real estate CEO. All right, I'll shift gears to the retail trend. Let me check how we're doing on time. We're at about 8:40, so I'll cruise through. I got about 10 more slides. I'll cruise through these, and then we'll see if there are any questions. But again, feel free to interject because that's more fun for you all and for me. Retail transforms and stores remain. Quote, retail isn't dead, it's just changing. Give it some time to adjust. Last year was certainly an interesting year in retail. I think it was somewhere around the third quarter that Amazon bought Whole Foods. I mean, that's sort of, wrapping your heads around that, whether it was a real estate play that Amazon's looking for presence in affluent communities, or whether it's a kind of a Sears play. People compare Amazon to Sears a lot about how they grew and where they grew. How we shop and where we shop continues to transform, but it looks like stores are going to remain, although changes are likely to continue. And as one interviewee said, that is not what one interviewee said. So e-commerce continues to rise as a percent of total. So we've been talking about this for years, right? That everyone's going to shop online and it's going to transform retail. We're seeing it in a meaningful way, but it is worth noting that e-commerce sales are now over $100 billion a quarter, but they still only represent 9% of retail sales. 9%. So that means 90% of folks are still doing their shopping in stores, which does not fit with my perception of reality as the Amazon boxes show up on my doorstep. But so what tends to be overlooked is just how large the retail market actually is. So that 9% is large, but that also means that the 90% are still in physical stores. The green is the in-store shopping. So stores aren't going away, but we certainly have more than we need. The obsolescence of retail is becoming a major real estate issue. And, there are other factors. I mean, Toys R Us, we saw that yesterday, closing all their stores. There are fundamental changes in apparel manufacturing. We're seeing fast fashion, not seasonal cycles. So not as much about what the, Paris fashion show is saying about what everyone will be wearing in 2019. It's more these fast fashion, and that's changing how and where we shop. Consumer preferences are changing for what they're looking for in a store. The best bet is non-boring retail. We used to call it experiential retail. But now we're saying things like the worst enemy of retail is boredom. So changing how we shop. This is 2016 shopping center gross leasable area square foot per capita. I'm sure many of you are familiar with this chart. America has so much retail space. Yes, we like to shop, but do we like to shop to the tune of 24 square feet per person compared to an Australia of 11, right? So this has been an interesting issue in real estate forever. I remember years ago I was working on Gwinnett's revitalization strategy. It was back in 2002. And Gwinnett was just beginning to struggle with what are we going to do with some of these corridors that keep getting the retail pulled out of them, and it's moving, one exit up 85. And, they said, well, Sarah, I don't understand because you're telling me we're over-retailed, that we have too much space, but everyone who opens a store gets filled up. And it's just that classic, they built a better mousetrap, right? And so you're leaving behind all the empty stores. And we're seeing that now. That trend has continued. And now we're seeing the meaningful impact of online. So that's going to continue to be how we think about this obsolete space and how we reposition it to be non-boring. It's different this time, the market outlook. Why deal with the uncertainty of a global market when there are opportunities in Salt Lake and San Antonio? This year's top 10 has a different feel in terms of top 10 markets for investment. Seattle jumps to number 1. Salt Lake City and Fort Lauderdale jump into the top 10. I mean, Salt Lake City is a pretty small market, so is Fort Lauderdale. But the real point, it's not just the particular cities. We look at the top 10 being as the tip of the iceberg. And what we see are more markets that had traditionally been thought of as secondary. Survey respondents and interviewees both expressed rising interest in markets that were growing and were more affordable when compared to the traditional gateway markets. That's what I was talking about before as the continuation of the trend. They're not always so affordable. Seattle is certainly not affordable, right? There are only 2 primary markets in the top 10. LA is more a story of neighborhoods and what specific neighborhoods folks are investing in. And Boston is about tech and highly educated workforce. So where is Atlanta in all of this? Its rating is 92 to 99% of the top 10s. So where they were rated, so we did not make it into the top 10. You'll see where they are at number 17. And I'll talk a little bit about that. Top destination markets for migration from primary markets, where they are up in the top 10, still receiving a lot of folks coming from primary markets to Atlanta, which has been part of Atlanta's story always. Inland Empire being way up there, Philadelphia with its adjacency to New York and being more affordable. You can hop on a train, get to D.C., you can get access. I was just up in Washington at ULI's headquarters, and the banter was all about the Amazon visit, which apparently they'll be here this month. And people loved Philly for Amazon. It was interesting, kind of having all of the benefits of the D.C.-ish area, but being more affordable and having great access. So that's not one that's been on my Vegas odds list, but an interesting observation. We also looked at how Atlanta rated itself relative to how other folks rated us. This is on a scale of 1 to 5, local economy and investor demand, as well as capital availability being just above a 4. Where we appear to be a little lower than historically is development and redevelopment opportunities, which, even, I don't know, you could look at your own business, but I look among ULI members and I see a lot of them doing more projects in Charleston and Nashville and Savannah, drive-to markets from Atlanta where they think they have more opportunity. Now, my counterparts in those markets are very unhappy about it because they have this perception that here comes the big guys from Atlanta, they're pricing us out. So they're having, it seems to have this ripple effect. So average score that we gave ourselves, the folks who participated, Atlantans rated Atlanta about 11% higher than the nation. That's our boosterism at play. That's the striped line relative to the national average. Our sector outlook, this is looking at each sector in Atlanta compared to the overall nation for this sector. Interesting that, multifamily, people are, apparently feeling okay about Atlanta relative to the nation. That's certainly where we've seen the most overheating. Industrial being below the nation, which, this is when you go, what are these people must not, know what's going on. But industrial's been a phenomenal success story, outpacing all historic numbers, as I'm sure you know. And, retail being sort of where we're performing worst. And that's speaking to the nation's really over-retailed. Atlanta's even more over-retailed. And so I brought a few copies that I think were outside if you want to read the full report. You can also, anyone can download it. You do not have to be a ULI member. You go to uli.org, ET18, and you can read all the charts and spend time with more of the trends. But, hopefully this gives you a sense of where folks are seeing Atlanta from a national perspective and some of these macro trends. I think, to me, the most, and you may have gathered from my comments, to me the most interesting are thinking about how the generational changes may change how we're thinking about place development, and then how we unlock this housing affordability challenge from both a production and a pricing perspective as being the ones that, from where I sit in my ULI hat, that I keep my eye on. So any questions or comments from the group? We've got about, I think, 10 more minutes. All right. Well, thank you for having me. It was, yes. So Atlanta was leading the Vegas odds for quite a while. I think we were 2-to-1 odds. I don't think we're leading right now. And quite frankly, the conventional wisdom is that following the situation with Delta, that really puts a major, and sort of said, that puts Atlanta out of the running if economic incentives are tied to policy and political positions. If you're Amazon and you see the city's largest and state's largest employer being sort of bullied, negotiated that way, then all of a sudden anything that we're offering for Amazon really, it doesn't feel like a good business. If I were them, that doesn't feel like a sound business decision. So apparently, I have some folks who are still really bullish on it, who don't have skin in the game. From just wearing my personal hat, if they were to come to Atlanta and be at the Gulch, I think that is transformative, which is the big site downtown envisioned as multimodal years ago. That is transformative for our region, and particularly for economic development opportunities on the south side of our region, where there's just still been such an imbalance of 80% of jobs and household growth have gone between 75 and 85 to the north. It's the right infrastructure. It's, suddenly unlocks this opportunity for downtown to be what we all hope downtown can be, which it's on a major investment downtown. There was an article in Curbed yesterday that highlighted the 47 new developments downtown. But something like Amazon and what it would do with the Gulch, to me, is really exciting. Some of the other sites would certainly be transformative for Atlanta. I worry about them from an infrastructure perspective. The GM site's another big contender. I worry about putting that much new development where we're already very intensely developed from just an infrastructure perspective. But MARTA service at GM and what do we call that now? It has like a rail assembly. Thank you. It never sticks. So it would be at assembly there. So that's just sort of my personal on the location. So it'll be interesting. You know, they're doing site visits this month, maybe even this week, and we'll see where it shakes out. You know, I used to be in the crystal ball business. I am no longer in the crystal ball business, and we used to say, you know, conventional wisdom was that cycles lasted for 6 years. Did I pass it? No. Here it is. Conventional wisdom was, you know, 6 years of growth, 3 years down. 6 years growth, 3 years down. That was sort of the, you know, historic pattern. And, you know, the conventional wisdom now is we had 6 years down. And so if we doubled the downturn, maybe we can double the growth cycle. You know, I am very sensitive to the fact that none of us saw the last downturn coming. I was at the time I was an analyst. I advised clients on where and how they should invest. I took great pride in the folks that I told no to, you know, because this makes absolutely no sense. I've run the numbers. I can push them as hard as I possibly can, and you're seeing the transactions at double that. And you know, there's no way the land prices, the anything substantiated it. So, you know, from a fundamentals perspective, a lot of us knew it was crazy. I don't think any of us appreciated how housing would, and, you know, mortgage-backed securities and so forth would just have this ripple effect through the whole economy. So I'm very, I'm very hesitant to, you know, ever make predictions. But, you know, barring outside events, I think folks, the line that was in here that I think I didn't read is, you know, if it's not a baseball innings, if this is a cross-country flight, we're somewhere over the Midwest, is the line from Emerging Trends, which, you know, here we are at this is more than 103 months now, I believe. But, you know, I think a few more years. But the idea being that this downturn would be a smaller, you know, it would be taking a breath versus passing out. Any other questions from the group? All right, well, thanks for having me, and get your copy of Emerging Trends. Thank you.
So thanks everybody for coming this morning. Sarah, thank you for all of the insights you've given us. Thank you to all involved in putting this wonderful event together. This concludes our meeting this morning. And don't forget, we'll have our next meeting April 19th at Ansley Golf Club, and we look forward to seeing you there. Have a great week and a great weekend.